If you are wondering what is an LP in venture capital and why they matter, then you are in the right place. In this video, I'm going to tell you exactly what an LP is and why they can either make or break your company. Think about that. You didn't even know what an LP was necessarily, and here I am telling you it could break your company. Stay until the end, and I'll share how a Russian LP almost killed a deal. So today we're going to talk about what is an LP, what are the different types of LPs, and why knowing who the LPs are and what types they are can be crucial when you're out fundraising. First, let's start. What is an LP? Well, LP stands for limited partner. And basically, it's the investors in a venture fund or a private equity fund. So let's say I decide I want to invest in a venture fund. When I do that, I'm going to go to that fund and I'm going to say, I want to invest $1 million. Now, I don't take $1 million out of my pocket and give it to the venture fund. Instead, I make a commitment. So over the next 10 years, I'm going to commit $1 million. And whenever the venture capitalist needs that money, they're going to call me up and they say, hey, Peter, remember when you promised to give us $1 million? Well, we need 50,000 of that, 100,000 of it, or whatever it might be, so that we can go make this investment in this sweet company that we just found. The way that all works is like I am an investor and I'm actually called a limited partner because those funds, when I wire them in, they're going to go to an entity called a limited partnership. So that limited partnership will own a bank account and my funds will wire into that bank account. They will collect all of the funds from all of the limited partners or investors, and then they will invest that into that really great, exciting company that they just found. The limited partnership, like I said earlier, is the actual fund, and it's actually owned by the limited partners, but they're limited. And why are they limited? Well, they're limited in two fundamental ways. The first one is, as an investor, I give up some of my control in terms of where my money is going to go. Now, the other way that they're limited is through liability. So let me give you a real world example. You remember when Mitt Romney was running for president? There was an article that came out that he was an investor in a company called Ashley Madison. Now, if you don't know what Ashley Madison is, it's an interesting website where basically it's like a dating site for people that want to cheat on their spouse. And so they were making a big hoopla around like, here you've got Mitt Romney who like talks about family values and yet he's invested in this company that helps people cheat. It turned out that what actually happened was that he had invested in a fund that had invested in another fund that had owned some equity in Ashley Madison. And so they traced it all back through. But because his liability was limited, he was able to credibly say like, hey, look, like I didn't make that investment. I didn't control that. That was made by somebody else. But in that way, it limits the liability because ultimately the limited partner doesn't have any control. Now that can also be important because they may want to avoid conflicts of interest and other things. So those are the two ways in which the limited partners are quote unquote limited. Now there are more ways, but those are the two most important ones. Before we dive into point two, I've got a trivia question for you. What do teachers, firefighters, policemen, and other government workers have to do with the largest investors in private equity and venture capital out there? Stay tuned because we're going to talk about it in this next point. Let's talk about the different types of LPs. LPs usually fall into the following main buckets. You have high net worth individuals, family offices, endowments, pension funds, insurance companies, asset managers, and sovereign wealth funds. So let's talk about high net worth individuals. These are people with over $1 million in assets outside of their primary residence. The idea is that they have $1 million of liquid assets, minimum. So most high net worth investors that invest in venture capital actually have, probably 5, 10, 50, $100 million in assets. Now, once you start hitting up into the $50 to $100 million range, it might make sense for you to start a family office. Now, a family office is this realm of ultra high net worth individual or family that has accumulated so much wealth that they can actually they need to hire people to manage that money for them. They've got that big chunk of cash and they've got to invest it. So they'll invest it in public equities and real estate and debt and bonds, but a portion of it oftentimes they'll invest in venture capital. All right, the next category that's very typical is endowments. These are large pools of capital from universities and foundations, and they invest in venture capital and lots of other assets so that they can donate more or give out more scholarships. They're investing 95% of their assets into businesses like venture capital, and then they're taking the returns and they're donating 5% of their total assets every year to maintain their status as a foundation. The next category is pension funds. Now, if you remember my trivia question from before, that's where these two come together. So pension funds are some of the largest investors in venture capital and private equity as limited partners. They manage the pension funds, the retirement funds of doctors, firefighters, policemen and women, and other government workers. And so what's kind of cool is that as a venture capitalist, if you're taking money from a large pension like CalPERS, you are helping fund the retirement of doctors and firefighters and police officers, which is kind of a cool thing. Another category of limited partner that's pretty common is an insurance company. So big insurance companies make money by taking your premiums that you pay monthly or yearly and investing them and then pocketing the profits. So it's very common that you see insurance companies putting capital behind private equity and venture. Another very common category is asset managers. Now I say asset managers, which is a pretty broad statement, but that could include a whole wide range of businesses, such as fund of funds, which is literally like a fund that invests in other funds, but it could also be large banks or wealth managers. Another example could be a sovereign wealth fund. So lots of countries have put funds aside for investing in other countries. Norway, for example, clocks in at the biggest with almost $1.5 trillion in their sovereign wealth fund. Now, not all $1.5 trillion is being invested in private equity and venture capital. It could also be deployed into real estate, debt, bonds, hedge funds, et cetera, but a portion of that is deployed there. Hopefully that was a good overview on the different types of LPs that exist, but so what? Who cares? Well, let me tell you why you should care. First, confidentiality. Let's say that one of your VCs, LPs, is actually a competitor to you. Oftentimes, VCs will disclose information about your business to their LPs, and you might not want that information getting out. These LPs are under NDA, non-disclosure agreements, and most VCs are very careful about what information gets shared, but knowing who their LP base is might be important for you as a business to control where the critical information about your business gets shared. The next reason that you should care is misaligned incentives. So while this rarely happens, it sometimes can be an issue where the LP in the venture fund has different objectives than you do for your business. For example, there was this one deal where the biggest LP in the fund required that every deal had to have a clause where the VC could force the company to liquidate because this particular LP didn't want to get stuck holding the stock of a company through a fund. And so, that VC had to have that term in every single deal. And for some companies, that could be really tough. Like, what if you're not in a good spot and the VC says, nope, we have a term, you have to sell because our LP wanted that. So that could be like an example of where incentives might not be aligned that you should be aware of. And then the last thing is misaligned interests and objectives. You may have a company that's trying to disrupt energy, right? And you want to come out with you have this new, great, cool alternative energy platform that's totally going to disrupt and put out of business big oil. Well, you may want to make sure that the LPs of the fund that's backing you aren't a bunch of people making money from big oil. So, sometimes that's something to be thoughtful about is hey, who are the investors? Are they the types of people you want to support? Now, this can also flip the other way, which is if you have large pension funds that are made up of a bunch of teachers, for example, and you want to benefit those teachers, then it could actually be kind of a benefit. Another example is your LPs, or the venture capitalists LPs, may bring strategic value to your business. So for example, I met with this fund recently. They do impact investing in the energy space. And a lot of their LPs, their investors, are large corporations. And one of the things that they were telling me is that they have generated literally hundreds of millions of dollars in revenue for their portfolio companies from their LP base, which is super cool. Now, the last thing I'll tell you, and this is maybe one of the key takeaways, it's as important to understand who the LPs are of a venture fund, in part because you want to know, one, is this a good venture fund? right? If they've got really good investors in the fund, then they're probably pretty good because they've generated good returns over the long run. The other thing is that if your LP base, and this is kind of a little bit of a secret, if your LP base is mostly high net worth individuals, they may struggle to make their capital commitments and fund the business or the venture fund over time. Whereas if they're institutional investors, they're less likely to fall through on their commitments. And so that's important, because if you're a startup and the fund is backed mostly by individuals, that money may not be quite as certain as if they were backed by large institutions. So, you know how I mentioned earlier I was going to talk about Russian LPs and killing deals? Well, think about the current environment we're in, where Russia is invading the Ukraine and all of kind of the things that are happening there. So your LPs matter. There is a fund called DST Global. They were an early investor in Facebook and backed by, you guessed it, Russians. So they actually had to come out recently and tell everybody that they no longer have any Russian money because entrepreneurs were refusing to take their investment, right? So key takeaway here, do your diligence on the VCs. Ask them about their LP composition and feel comfortable pushing. You should know where the money is coming from and feel comfortable with those investors. If this was interesting and helpful, check out my next video where we're going to talk about whether you can invest in venture capital firms.